Too much cash, chasing too few assets. Your take, please.
That's absolutely right. And the big surprise has been that part of the fiscal stimulus, the checks that went out, ended up in the marketplace. So not only do we have monetary stimulus going into the marketplace, we have fiscal stimulus going to the marketplace. So we have the situation where there is a lot of liquidity sloshing around, and it's just looking for a home. And everything you've talked about so far indicates this. And the interesting thing, John, is that we have certain visibility on how much further liquidity we're going to get, and it's a big number.
So, Mohamed, that's the important part of this. You can identify the conditions that lead to this outcome. Then you've got to ask yourself whether they persist. And, Mohamed, looking at the numbers we're seeing, it looks like it will.
So it will persist on the injection side. You know, we know that the fiscal and monetary is likely to be about 15% of GDP, and that's fiscal package 1. Then there's a question mark about how big will fiscal package 2 be, and then there's a question mark of how much excess savings are released back in the economy. You add all that up, John, you're somewhere between 20 to 25% of GDP. So that side is known. What is not known is what happens to those funds, and in particular, what happens when we reopen the economy properly. You know, economists always make a difference between notional demand and effective demand. Notional demand is what you and I want to do but cannot do, but are not able to do. Effective demand is what we actually can do. And the economists are starting to ask the question, if some of this notional demand becomes effective demand, the supply side doesn't respond that quickly, do we get such a jump in the price level that both the markets and the Fed have to react? That's the big question right now, and it's the one that every market participant should be having a view on.
Well, I'd love your view on it. Mohamed, what is your view on it?
I think we're going to get a price pop, a price level pop that is larger than what most people expect for this year. And then there's going to be a debate among the economists. Is it inflation or is it a once and for all? But the marketplace is not going to wait for that, putting the Fed in a really hard position. Does it allow the potential of disruption to the equity market? Or does it go further in and do either more implicit or explicit yield curve control? I wouldn't want to be the Fed in a situation where the price level pop ends up being much larger than what is currently expected.
So right now on the screen, equities lower, bond yields higher at the long end. But this week, Mohamed, we've seen the post-pandemic high on a 10-year of 119.81. We've also seen the record high intraday on the S&P 500 on the very same week of 39.31.50. So, Mohamed, my question to you would be, for the Federal Reserve, I think it's quite simple. If yields are higher, but financial conditions are still loose, they don't respond. Do you think that yields can go higher and financial conditions more broadly can stay loose?
Yes, if they go higher in an orderly fashion. So most people are quite comfortable seeing the yield curve steepen moderately and slowly. It is what happened at the beginning of the year. I mean, people have forgotten that the first four trading sessions, the first full week we saw a massive move, a 20 basis plus move that got the Fed to intervene verbally pretty quickly because that was too fast. So it is the pace of steepening that's going to be critical.
So, Mohamed, this puts the Fed between a rock and a hard place, because if they step in too soon and they stop what's happening in this economy, they'll be accused of helping the people at the top end because they've boosted asset prices and not allowing this labour market to recover sufficiently to remove all the cyclical slack. If they act too late, they'll just let asset prices keep on ripping. Can they win here, Mohamed, so to speak?
So the way they win is by maintaining calm in the bond market, maintaining calm in the equity market, and letting fundamentals start validating asset prices. That's how they win. That's their way out. It's a tough way out, but that's their way out. And you saw that. Look at what Chair Powell told us at the New York Economic Club. He was very clear. He said, I am pedal to the metal. I'm going to keep these markets calm for as long as possible. And then he urged more fiscal action. So, you know, what the Fed wants is to keep control of financial stability and allow the fundamentals to validate what everybody acknowledges are elevated asset prices.
This Fed is very focused on inequality, though. You've heard it in the speech, and I spoke to the former New York Fed President Bill Dudley in the last 24 hours, Mohamed, and I asked him the question, Something's changed. A couple of years ago, you'd be asked about inequality. You would say the blunt tool of interest rates can't address that. Now they want to address it. You've talked about that spread between the economy and finance, the economy-finance gap. You wrote about it earlier this week on Bloomberg Opinion. From what you see, from what you hear, on the monetary policy side and on the fiscal side, do these policies exacerbate that gap, maintain it, or do they actually help close it anytime soon?
So on the monetary side, unfortunately, they make the inequality issue worse. The fiscal side is yet to be seen. With the exception of the Bank of England, most central banks haven't been very good at paying attention to the inequality issue. The Fed itself acknowledges that their instrument aimed at getting to the economy, if you like, people's QE, haven't worked. They've been a great disappointment. So I think, the Fed will talk about it, but ultimately it doesn't have the tools. It's going to be whether the fiscal side responds. And that's going to be critical. And John, I have to stress, it is not just the inequality of income and wealth, as bad as that become. It's also the inequality of opportunity. Yep. And that is the big risk.
Final question, Mohamed. Market-based. In the bond market right now, at 4 basis points on 30s, almost 2%, on a 10-year up to about 119. Look, a year ago, 2 years ago, 3, 4, 5, 10, 20, 30 years ago, these are levels which were just unheard of, Mohamed. The level we're at right now, do you have a bite point in mind for this market where you think things start to get tested, when yields start to compete for capital elsewhere? It can't be 120. What is it in your mind?
So if we get to 150 by the end of the week and by the end of the month, and that's not difficult, we saw what happened at the beginning of the year, then that will be disruptive to the market. If we slowly go up and we're at 125, 130 by February, then it will be the same conditions that we see today.